Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. This is Trading Places Live. It's Thursday, September 29th, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we have futures down after a really nice rally on Wednesday. We see the Dow futures down about 155, S&P futures down about 26, NASDAQ futures down 117. It's coming on the heels of the 10-year Treasury yield being back up 12 basis points today after having the biggest drop since back in March of 2020. Had an absolutely huge decline yesterday on that 10-year Treasury yield. I think that spurred a lot of buying in equities. But today, this morning, we see the yield back up, and I think that's one of the reasons why we're seeing futures down. Crude oil prices currently up, about 35 cents, 82.5 per barrel. Before we get into anything today, let me go through the agenda with you. So we're going to start off with the daily market recap, then talking technically. I want to do a 1-month rotation segment. Big announcement back on August 27th when the Fed Chief Powell had that Jackson Hole speech. It's been about a month since then, maybe just a little more. And I just want to show you how you can go back and use chart lists and the summary form of the chart lists and look at a 1-month period and just see what the rotation's been like since that speech. I think that's a little bit telling of what the stock market is feeling, what Wall Street's feeling, the story out on the street. So we're going to do that. Then we'll get into earnings spotlight and we'll wrap up with the 3 you must see. But we'll be into all that in just a minute. Let me first take you to earningsbeats.com. For those of you who are new, go to earningsbeats.com, scroll down. We have a free newsletter. This is our Earnings Beats Digest, where every Monday, Wednesday, and Friday, I do publish a very brief, usually 2-paragraph, 1-chart newsletter. It's just a little nugget of information about the market. It could be on an index, it could be on an individual industry group, it could be on a sector, it could be on stocks. A lot of things we like to feature are earnings, earnings-related gaps, relative strength, candlesticks, volume and price, so support, resistance, trend lines, those types of things. So if that's something you'd like to get 3 times a week, go over to earningsbeats.com, scroll down, make sure you sign up. Also takes a name and an email address. No credit card required. You can unsubscribe at any time. All right, let's move on to the daily market recap. So what the heck happened on Wednesday? Well, we had a big rally. If you weren't around, we saw the Dow Jones Industrial Average move up 548 points. S&P was up 72, back above 3,700. NASDAQ up 222. It was actually able to climb back above 11,000, which was nice. Mid caps up 60 points. Small caps up 29. On a percentage basis, mid caps and small caps did better, which was good. But notice from a more bigger picture outlook, if you look at all the major indices, yeah, we reversed the downtrend at least for a day, but we've got a declining 20-day EMA that we've now got to try to work through with a not so good PPO. So for me, if we do rally here in the short term, I'm going to be keeping an eye on the 20-day EMA. So on the S&P 500, for instance, right now that's at 38.58. Remember, all of those key tests that we had at 3,900, we've got that to try to overcome along with the 20-day EMA at 38.58. This is not going to be, well, at least technically, you wouldn't think it's going to be an easy move right back up through those levels. So I will be respecting those levels until we can clear them, especially with that daily PPO pointing lower. Maybe we go right through them, and if we do, that'll be great. That'll be very bullish, but I will be respecting those until we can get through 20-day first, and then look for the key price support. In the case of the S&P 500, that would be 3,900 in my mind. Looking at the sectors, 11 sectors, all 11 were higher on Wednesday. In fact, all 11 were up at least 1%. And it's not shown here, but the worst performer, which was up just over 1%, was technology. That was not a great look to yesterday's rally, having technology down at the bottom. But the rest of it wasn't bad. Energy led, of course, crude oil prices now back up above $80 a barrel. I think that certainly helped energy, which had taken a pretty big dive. So we got a big rally there back up to 72.60. And that was up over 4, excuse me. That was up over 4% on Wednesday. Then we had communication services up 3.4%, discretionary up 2.7%, materials 2.6%, and industrials 2.2%. So it was a widely participated rally, or wide participation rally, which was good. We want to see that, especially trying to come off a bottom, trying to mark a bottom. So all of that's good, but notice the sectors have the same problems that the industry, or excuse me, that the major indices had. So look at the 20-day EMAs on all of these sectors. They are now below the 50, and we've got price action below the 20. All of the PPOs pointing down below the center line. So we've got momentum moving bearishly. And when I look at rallies, when we do get counter trend rallies, and over the last month, there's no doubt we've had a rally or a move to the downside. So this is a counter trend rally to what we've been seeing for the last month and a half. When I see the PPO lined up like this, moving lower and below the center line, and I see this bearish configuration with the 20 below the 50 and price action below the 20, these rallies I expect to fail at the 20-day, at least initially. If they don't and we go through, that would be great. But if I'm trading and I'm on the long side, I have no problems taking some profits as we hit or approach those 20-day moving averages, and then we'll see if we get through. Again, if we get through, that would be bullish. If not, we could come down one more time. Wouldn't be surprised to see that 36.23 low revisited again on the S&P 500. So don't think that we can't go back down there. Let's see, what else do we have? Actually, I'm going to pull up that S&P. And I just wanted to see, I said 36.23 low. Yeah. For some reason, I was thinking maybe that low went a little bit lower than that, but it is 36.23. So, yeah, I mean, I think if we can't get through the 20-day on this rally, then I think 36.23 could be revisited sooner rather than later. It would be good, obviously, to hold it and then go back up. We don't want to break down again, but that is a possibility if we cannot get through the 20. So that will be something to watch. Another thing to watch, and this, if you go back and you look at how shorter term bear markets morphed into secular bear markets, one of the things I noticed about the 2007 to 2009 decline was that the AD line held up for a while, but when we finally took that next really big move down in the secular bear market that really marked it as a secular bear market, we saw the AD lines begin to fall apart. So that might be something to watch for. One thing that I have talked about in 2022 is that the AD lines have remained pretty strong. Just keep in mind they did that as well back in 2007 and into 2008. But then by mid-year, when we started to really begin to drop, that's when the AD lines fell apart. So that might be something to watch for if you're thinking this is more of a longer-term secular bear market. I do not believe that. Anybody who's listened to the show, I think you know that by now. Doesn't mean I'm right. So that's one thing I would look at. The other thing with secular bear markets you have to understand is they're based on longevity. You can't have a secular bear market that lasts 6 months. Secular bear markets last longer. In fact, if you go back and you look at every secular bear market in the last century, the monthly PPO goes negative. The monthly RSI goes below 40. We're not in either one of those situations yet, but the bear market hasn't lasted long enough. So that's something to just keep in mind, to think about. That would be confirmation of a secular bear market. When a bear market starts, you really don't know for sure which one it is. I believe we're in a secular bull market, which is why I called for a cyclical bear market at the beginning of the year. I believe it's going to fit into this theme or theory of the long-term secular bull. And I think the rotation back into aggressive groups starting back in June, I believe is Wall Street moving in, preparing for the next leg up. That's what I think's happening. Could I be wrong? Sure. If I'm wrong, I would expect that money would rotate back out of those groups. We'd see new breakdowns in some of the ratios that I like to follow, and we'll see the market break back down again. We'll see the AD lines roll over. We'll see those monthly PPOs eventually get through the zero line to the downside. We'll see the monthly RSI drop below 40. Those things, it's hard to predict those in advance at the beginning of unless you're really, really bearish. I mean, if we had been in this secular bull market for 2 decades, then I might be saying, hey, let's batten down the hatches. It could be time for something really, really rough. I didn't see that, and I still don't see it. Doesn't mean I can't be wrong, though. Try to remain objective, look at the evidence, and go from there. 10-year Treasury yield. I know I spent a long time on that other. We'll try to pick things up here a little bit. The 10-year Treasury yield, I mentioned yesterday morning in my show that I thought one thing that could spur the stock market rally would be a big drop in the Treasury yields, maybe back to yield support. And what I would be looking at for yield support is that prior top right here, which was at close to 350, 348. Notice we got up to 4%. And on this pullback, where's the 20-day on the 10-year Treasury yield? The 20-day EMA, it's at 350. So it's right at the yield support. So if we continue to move down, this, I think, could give stocks the impetus to get up there to their 20-day. Whether we go through the 20-day, I think in large part could be based on whether or not the 10-year Treasury yield goes back through the 350 area to the downside. If Treasury yields bounce, I think that's going to continue to spook the market. After all, got a lot of folks still talking about inflation. Fed's still talking about inflation. Rates are still going up. Fed's still talking about raising rates. Rates are a big deal. And if you look at how the S&P has traded this year, it's been almost a mirror image to the yields. When the yields go up, the S&P goes down, and vice versa. Watch what's going on in the 10-year Treasury yield and in the Treasury market in general. All right, let's move on to talking technically. Just a couple things here I want to show rather quickly. S&P 500, I do like that candlestick yesterday. I like the volume coming in off the bottom. I thought that was a really constructive way, perhaps, to put in the bottom. I mean, again, call this what you want. We did actually go slightly below the June 17th low, which was 36.36. We hit 36.23. So for those of you who are saying, hey, you got to call and say you were wrong because I called the bottom back in June. Hey, technically I'm wrong. I mean, that's an easy one. 36.36 was the low. Now it's 36.23. My bottom call was wrong. Now, if we turn around and rally from here and we have a double bottom, I'm still going to say that was a pretty darn good call. And what I'm looking at right now suggests that we probably are at a bottom again. So to me, this is like, I think I was kind of half joking back on Tuesday, but I think this is market bottom 2.0. One of the big reasons, I talked about the rotation. I talk about that a lot. I don't want to get back into that again. But I want you to look at where the 5-day moving average is of the equity-only put-call ratio. We're at 0.83, 0.836. We're actually now above where we were in June, meaning that there's even more folks playing puts. You think, well, hey, that's because everybody's bearish. We're going lower. Well, this is a sentiment indicator that is contrarian. And what you'll see is that when we have peaks in this 5-day moving average, that's when the market bottoms. So here, back in June, when we peaked, look at when the bottom came in, right to the day. Look back here at this peak in January. Where'd the bottom come in? Right to the day. Look at this peak, this peak, this peak. I mean, these are short-term indicators. So you don't necessarily call, I didn't call a market bottom in June, long-term market bottom, just because of this. It was because of rotation. There were a lot of other factors that went into it. But this was one major factor where we can look for a reversal. Even a short term. Look back beginning of September. We got up almost to 0.80, 5-day moving average. Look at the top, or excuse me, look at the bottom, right at the top. So if this starts to roll over, when it starts to roll over, that's a pretty good indication that you're going to start an uptrend. Not a guarantee, a good indication, a signal. If you're somebody who's like, okay, when do I get more aggressive? Well, in my opinion, you get more aggressive. One reason would be when this 5-day moving average peaks and starts to roll over. Let's look for that. This starts to roll over. We're already making a move up. Now today, again, with futures down, maybe we go back down and get close to the recent low. I don't know. I mean, we're only finished on the S&P at 37.19. The low was 36.23, so it's less than 100 points away. That's just a bad day sometimes on the S&P 500. So let's see what happens with the market. And also let's watch this 5-day moving average. If it starts to roll over, I think in the short term, we're probably in for a rally. It could just be something like we saw in early September. I mean, if you go back and look at all these peaks, here was a peak. We had a little rally and then we rolled back over. Here we had a peak. We had a rally. We rolled back over. So we could peak. We could rally on the S&P and we could roll back over. This, again, is not a long-term signal by itself. You've got to have other factors out there. And some of those other factors would be, well, we have a double bottom in. That's the way bottoms form sometimes. We have money still rotating towards the more aggressive areas. That's how bottoms form. So we do have the other ingredients in play. And that's why I think this could be market bottom 2.0. We'll see. All right, let's move on. I wanted to talk a little bit about this 1-month rotation and what you can do with it. So for me, when I'm looking at the market and I see a significant event happen, that can be marked on the chart. If you go back and you look at the S&P 500, see this candle right here? That was the Jackson Hole speech by Fed Chief Powell. And it's been about a month since then, and we've had a big drop since then. So you put all that together and you say, well, okay, we know the S&P's gone down, but what's the overall market done? What's been doing better than average? What's been doing worse? If Wall Street is repositioning, what are they repositioning into? Individual stocks, industry groups, what's going on? Sectors. We need to know the makeup of this move back to the downside, because if it does turn out to be the bottom, we want to know where Wall Street is positioning. So again, one thing I do is I just go in and look at different areas. Now I'm going to first point out how you can, this is the Dow Jones index. And you might say, well, I'm new to StockCharts. I don't even know how you get this chart list. How do you do this? Well, let me show you. Let's just go back over here and we'll go back to the dashboard. All you have to do is run a scan, a simple scan. Now you do need to be a member at StockCharts. This is a great time to join, by the way. 30-day free trial, which is always out there. However, ChartCon is next week, and anyone who goes to ChartCon, I believe they're charging $299 to come in. It's a 2-day event. But if you're a member, even a free trial member, you'll get a substantial discount. I believe it's only like $99. Don't quote me on the price because I'm not positive, but I think there's a substantial discount if you're a member. So just go in and join as a free trial member, and then your cost goes down to just $99. I'll be there along with 16 other great technicians, some very, very well known. If you follow through StockCharts, you'll probably know just about everyone. But even if you're not a StockCharts follower routinely, you're going to have folks like Ralph Alcampora, Larry Williams, Linda Raschke, and a number of others who you probably know from StockCharts. Martin Pring is going to be there. I'm flying out to Redmond to meet with everybody. It's the first time that we've all gotten together since the pandemic. So it's really exciting for all of us to get together. I think it's going to be an absolute dynamic show, an event. So make sure that you sign up for at least a trial if you want to come to this event. It's going to be virtual. It's all virtual, but we're all going to be live out in Redmond doing it from their new studios. It's going to be an awesome, awesome event. Really looking forward to it. Anyhow, so what you want to do if you want to pull up these chart lists is just say, I want to do a new scan. Very simple. You don't need any filters. You can get rid of all that stuff. All you need to do is go down here to the indexes, drop down menu. See the Dow 30? Add that. Now it's up here as a filter, run the scan. There's your Dow 30. You want to put it in a chart list, save to a chart list. I'll just call it test or test 2. I don't know. And now I've got test 2. It's in summary form. What if I do a 1 month? Now I've got Johnson & Johnson, WMT leading. Well, here's my chart list I was showing you. There it is. I just have it in a different folder. So that's how easy it is. You can do that with any of these scans, by the way, any of these indexes. Put the NASDAQ 100 in a chart list. Put the S&P 500 in there. There's your S&P 400. Here's your 600. And then you can do this with all of them and see what's going on in the last 30 days. So here's the Dow Jones over the last 30 days. There's only 2 stocks in the Dow that have been up since basically right after that speech by Powell. Johnson & Johnson, Walmart. Then you got a couple of other healthcare related names, Merck, United Health, Amgen. These have all done better than the S&P. Notice JP Morgan doing better than the S&P. We got JP Morgan earnings coming up mid-October. Is Wall Street repositioning into JP Morgan? I mean, it looks like it a little bit. It's outperforming the S&P. Is that a signal? Well, we're going to know more when they report. But yeah, I mean, this is something I pay attention to. What's not performing well? Well, Boeing, Intel, semiconductor's been horrible. Dow Holdings, Walt Disney, Caterpillar, Visa, 3M. 3M's been awful. Anyway, those are names that you might want to be cautious of. Wall Street's actually moving more out of them than they are other areas of the S&P and the Dow. This is actually the Dow. But we could do the same thing here. I've got the S&P 500 components. Let's take a look there. What's going on? Well, on the S&P, FedEx, of course, they warned. That's the worst performer since just after Jackson Hole, that speech. FedEx is the worst performer on the S&P 500. Western Digital, Adobe, software company, Lumen Technologies, Newell Brands, AMD, another semiconductor there. These are all stocks that have been underperforming. What in the S&P's done well? Well, Biogen just had a great positive drug announcement on its Alzheimer's drug. And so it just gapped up hugely. Just, I think it was yesterday. Getting all my days confused, but yeah, it was yesterday. So most of this was just from yesterday. Another stock in healthcare, though, Regeneron Pharmaceuticals, another pretty good winner. Look at the cruise lines. Royal Caribbean, Norwegian Cruise Lines, Wind Resorts, Netflix. Interesting. These are all companies that have been underperforming for a long time. What is Wall Street seeing? That's a light bulb that goes on in my head when I look at something like this. Should I be thinking about Wind Resorts? Well, as long as that relative strength line continues like it has for the last month, absolutely. So this is a great way to do it. And one other thing I'll show you with this that I like to do is I keep relative strength of sectors and industry groups. So we can do the same thing over the last month. Here are the sectors. You know, I know that everyone's saying, well, this is going to be horrible for the market going forward, right? Rising rates, the economy is going to stink. Well, look at do you find it maybe somewhat odd that the 2 consumer groups are in the top 3? Wall Street's moving into those groups. They've outperformed the S&P 500 over the last month. Consumer groups. I think that's kind of strange. Meanwhile, though, we do have healthcare. We've got utilities. So we got a couple of defensive groups there. Industrials and technology not performing great. They're a little bit below the S&P. communication services as well. So those are three aggressive groups, but they're not on the bottom. Look at what's really being tossed out. Materials and real estate. Wait a minute. Time out. Aren't we worried about inflation? I mean, those would be that would be where I'd be putting my money into if there was an inflation problem. Remember, Wall Street looks out 3, 6, 9 months. Wall Street's looking out and it's not seeing inflation. It's not, I'm not saying that it's not seeing it. What it's seeing is that it sees inflation coming back down. So inflation will probably still be elevated in 9 months, but it's probably going to be lower than it is right now. And if that's the case, the pressure to raise rates goes down. I think the treasury yields come down. And these areas that a lot of folks were hiding in, maybe earlier in the year or last year because of the inflation scare, this is what Wall Street's getting out of now. I wouldn't be in these areas. Just my opinion. All right, quick little earnings spotlight. Let's take a look at just a couple of companies real quick. So we've got Vail Resorts that reported. They came out, they beat expectations, but they were expected to lose $2.91. They lost $2.70, and we'll see what happens. It's down here near a support area. I like to look at relative strength going into earnings reports, and this one was just not very good relative to its peers. So I'm going to say no to Vail. Just not liking the chart. Another one is Jefferies Financial Group. AD line looks pretty good. Look at the relative strength here. It's actually a leader in the asset manager group. This is one that kind of would be interesting. They did beat $1.10 versus 69 cents. See what I didn't even look to see reactions yet. The reaction on this one, it's flat, up 4 cents. But with the market down, pre-market anyway, futures down, that's not bad. We'll see. I wouldn't be surprised to see it run back up to the 31.5 area, at least test that 20-day with good results and some relative strength. I think that one could do okay. All right, 3 you must see. Let's wrap this up. Netflix, just wanted to point out, look at that AD line. Seems to me like there's some accumulation going on. Beautiful candle yesterday, volume picking up. When we've seen volume the last few months, we've seen rising prices. Big level up around 250. If we get a breakout, I think Netflix could run. Keep this one on your radar. Illumina, this is a company that's been downtrending for a while, but notice the AD line was going down until June. Since then, we've been going sideways, but the AD line's been going up. Yesterday, volume picks up, moves back through the 20. Another one, keep this one on your radar. Last one, PayPal. Are we ever going to see a bottom in PayPal? I don't know. AD line, flat, not really doing much. You look at the relative strength, it's starting to pick up a little bit, but the group that it's in is horrible. I need to see more on PayPal. Yeah, yesterday was pretty good. Get me through about 105, and then let's talk. Until then, I'm going to probably stay to the sidelines on PayPal. All right, that's it. Everybody have a great day. Have a great rest of your week. I'll be back next Monday for your next Trading Places Live. That'll be over at earningsbeats.com. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.